Hi, everyone. This is Dan Whistler from Mortgage Automator. Really happy that you're able to join us today. We're just going to give everyone a minute or two before we begin with the content to let everyone get in and get settled. Okay, let's begin. Morning, everyone, and welcome. I'm Dan Whistler. I'm the Chief Revenue Officer here at Mortgage Automator. So my role is focused on understanding what lenders really need to grow and operate efficiently and making sure that the solutions that we bring to market deliver on that. Mortgage Automator is an end-to-end loan origination and servicing platform built exclusively for private lenders. From the moment a loan application comes in to the day it's paid off, we automate the workflows, paperwork, and reporting that slow lenders down. So your teams can focus on growing the business, not managing it. And whether you're an individual lender just getting started or a fund manager overseeing a large portfolio, Mortgage Automator is built to scale with you. With over 400 customers, we're proud to work with some of the most innovative lenders in the industry, including the two gentlemen joining us today. A quick note on housekeeping before we dive in. Today's session is being recorded. We'll be sending the recording to everyone who registered for the webinar. So if anything comes up and you need to step away or you get a call, you won't miss anything. If you have questions for our speakers, please drop them into the Q&A chat as we go. We'll be collecting them throughout and we'll address them at the end of the session. With that, let's get into it. Today, we're joined by two experienced voices from the private lending space, Ryan McNeil, co-founder and president of Keystone Capital Group, and Jake Lasko, president of Defiance Capital. Between them, they bring decades of real-world experience, and we're looking forward to a candid conversation. So let's begin. Jake, how about we get started with you? Walk us through how you got into private lending, your background, what originally drew you to the space, and where Defiance Capital was when you began, where things are today.
Sure. Well, thanks, Dan. So I came over and actually helped my business partner kind of get Defiance Capital off the ground. I spent 14 plus years in commercial and retail banking at US Bank, focusing on relationship management and underwriting skills, making sure that we were bringing success to businesses and commercial real estate. In 2020, came over and joined my partner who had been doing some very limited private lending, and he saw the opportunity, specifically in the Oklahoma market, to grow by having a very focused, targeted response to relationship management and providing capital to clients in the specifically Oklahoma City and Tulsa markets. So early on, this was small. This was still very grassroots, just kind of dabbling to see what the interest would be if a private lender like us showed up in the market to help investors grow. A lot of mom and pop operators in Oklahoma. We're able to do a lot early on to grow that and have been having a great time just seeing the growth of the investors we've worked with and using the expertise of the commercial lending background to help SFR and small multifamily transactions occur.
Awesome. So not to get right to the finish line, but that was the beginning. Kind of what scale are you at now? And what does the business look like today?
Yeah, so we have I would like to say we've been controlled growth, but when you do, the magic we've seen is that hyper focus in a market, understanding that market potentially better than your clients do, is a huge trigger to bring that total idea of mutual success that we want to bring our clients. They see that we are invested in their community. We show up, we talk through deals, and we give them a level of feedback because of our lending background first that sometimes they're not always getting from other private lenders that they've talked to. So we are now, growing past 300 loans annually, managing 150 to 200 at a time. And these are small volume, high turn loans. Average loan size about 150,000 because Oklahoma has some incredible metrics when it comes to the dollar amounts you do per loan.
Amazing. Excited to dig in more. And we'll be getting into that today. Ryan, same question for you. I guess a bit of a twist in your own background. You came up through a family business, got to kind of watch the lending operations scale, and then kind of went out on your own to build from the beginning. So can you tell us about your journey? First, again, personal background, the family business, how long it took to grow, all of those sorts of things, and then what led you to start Keystone Capital? What was the vision and kind of what does it look like today, a few years down the line?
Yeah, absolutely, Dan. First off, thank you and the team for having us today. Really appreciate being here. As you'd mentioned, I started off in a family business, Graysbrook Capital, Atlantic Canadian-based private lender. They had started back in the early 2000s. Several years, they floated around 20 to 40 loans and eventually decided they wanted to scale. They initially focused on kind of the poor credit, purchase and refis, and DSCR loans for real estate investors, and eventually started dipping their toes into construction and small multi-units, always based in the four Atlantic-based Canadian provinces. And I eventually had the opportunity to join. I was living in Toronto at the time. I had an opportunity to join them and move back to the East Coast where I grew up. And over the next couple of years, we were able to scale the business to about 120 to 140 loans. Loan sizes were smaller back then, so our portfolio was just shy of $30 million. And we ended up selling that business to a local credit union here in Halifax. I joined the new parent company and operated the subsidiary. My father and my uncle, who had started the business, both retired, and I stayed there for about 3 years. We obviously had much more capital availability at the time. Scaled that business to about 120 million, about 300 loans. We started more so heavily focusing on the multi-unit and commercial side. And then I decided it was time for a new challenge. So as you mentioned, Dan, went off on my own, started Keystone Capital about 3 years ago. We had initially started pretty small, primarily DSCR loans, flips or BRRRR type model, very much focused on real estate investors. And once we developed that bit of a track record and our capital resources started to increase, we started to introduce construction loans as well, which are a big portion of our portfolio now. And just last year, we created a mortgage investment corporation, or a MIC, as it's referred to in Canada. Basically, Canada's version of a residential mortgage fund. And it allowed us to further scale on the investor side and start introducing larger residential loans and commercial loans up to 2 million.
Amazing. Congrats on the success. Sounds like a pretty wild ride. And then if there are questions around the differences between the Canadian and US market as we go, shoot them into the chat. We ultimately are talking about the same topics, but with slightly different regulatory requirements and slightly different language. Like if we end up getting too far down the road in one jurisdiction, just let us know in the questions and we can sort everything out. But thanks so much, Jake. Thanks so much, Ryan. Appreciate the background. In terms of where we go next, so I think the first question we'll start to dig into is how we started thinking about moving and growing. Like what was that trigger to start thinking we're ready for the next challenge? Ryan, having watched the family business grow, you probably had a bit of a blueprint that some founders don't have. You were able to see that. So when you were building the foundation for Keystone, thinking about processes, capital, finding partners, how much of that was deliberate from that experience? Was there a lot of debate amongst your partners earlier on? What was kind of the early stages?
Yeah, absolutely. I love this question, Dan, and I think it's super important when you're planning for starting or scaling a new business. We went super deep on planning before we started. We probably had a 30-page business plan. We had a signed shareholders agreement before we even press go. So having the roadmap was extremely beneficial to me. So very thankful for that. And thinking back to my early days when I was with the family business at Graysbrook, we didn't have any process documents written out. We just kind of flew by the seat of our pants for a lot of it and just kind of figured it out as we went. Small business. But once we were acquired, one of the first things the new parent company did was have us to write out all processes for everything involved in the business. And that was one of my biggest takeaways from working there, and keeping these evergreen, just to allow for a more seamless transition when you inevitably experience turnover or you need to cover a role or task for a period of time. Very important to have. So that was super important for us when we started Keystone. We had processes implemented from day one when we started, and we continue to do so today, about 3 years in. We're also very fortunate to have AI tools now that assist with this and make it more efficient. And in terms of my partners, obviously a lot of time went into selecting this. I partnered with a past underwriter I had worked with before, and plus another partner who raised capital on the investor side. And of course, we have disagreements all the time in terms of strategic direction, but what we do is we have a quarterly board meeting to discuss the strategic direction. Of course, it's easy to get caught up in the day to day, and you don't end up spending as much time as you'd like on this. But we definitely continue to have disagreements on direction, but this forum allows us to kind of openly debate and move forward with group decisions.
Yeah, it makes a lot of sense. On that topic of kind of documenting things, I think that's something that we experience at Mortgage Automator a lot. People have realized their manual processes, they've outgrown their manual processes. They start coming to us, and that is often the initiation of documenting these things in implementation of Mortgage Automator. That's when people are realizing, oh yeah, these are all these exception cases that we've never written down that when we're trying to build systems for it, get uncovered. So may have felt like work at the time, but probably good to have documented all of these things to allow for plans for your next business.
100%. Good bar.
Awesome. Jake, I think your situation was a little bit different. There were some kind of key outside forces at play in your market, COVID, regulatory changes that really accelerated things for Defiance. Can you take us through that and kind of as volume picked up, did you stay laser focused on your original niche? Did you expand to different loan types, geographies? Talk us
Well,
through
and I'll
that.
kind of touch on, from Ryan's background with the way, he had the introduction and then selling that off and transferring over and starting the new venture. One of the things that my partner and I have done is it's been a little more grassroots, kind of developing the processes as we go to keep ourselves nimble enough so we can react to the market. Now going back to kind of the growth trigger, Oklahoma was the focus. We do actually both live in Colorado, so this is not a right around the corner stop. But my partner had some rental properties in Oklahoma identified as kind of a need for capital there, to help investors, especially on the smaller deals. And again, we caught this in 2020. And one of the things that the city of Tulsa specifically had been offering is folks the opportunity to move to Tulsa as a remote worker and get some stipends to live there. And so that really triggered a lot of investment in Tulsa because now there was a whole batch of new people who all of a sudden were remote workers in 2020 because of COVID, and they were looking for potentially a cheaper cost of living location to call home for them and their family. So that was a huge play that you can't bank on that happening in your own business growth. But again, keeping the mindset of Ryan, the idea of, you have your processes set and you go, or you could be a little bit more grassroots and be a little more nimble. Again, there's no right or wrong way. And that's what I love about this particular setup with Ryan and I is there's a couple of different paths we've each taken, I think, kind of get to the same place. Um, so of course, being there when these investors were looking for the fix and flip loans, and then they were also then doing a lot of buy and holds and turning these into rentals because people were moving to Tulsa or Oklahoma City and wanting to just have a year or two to kind of figure out if that was the place to call home. But again, that we stayed focused on those core products, just helping folks get into quick capital, give them the access to get the rehabs done fast and get out. Now, of course, the market has since been evolving and changing. We have added products. We do some new construction as folks have seen the market shift and buyer demand change. And Tulsa and Oklahoma City have some infill lots just within city lines that have been interesting to grow. The new construction business in that capacity, again, buyer demand has said that's kind of what people want. And as we continue now to look at Western Colorado, taking those same principles and now just applying it to a different market and different types of investors and what their actual end goals are going to be. And now starting to really build some concrete processes about how we're going to do that to cement ourselves and be able to now scale this in a more effective way.
Yeah, makes a lot of sense. I mean, I think we'll always have to be monitoring market circumstances. Things can change quickly. Regulatory situations can change quickly. So the trigger of COVID, hopefully we don't have something like that again. But I think the need to monitor what's going on to guide the business will always be there. Curious though too on customers and how much customer demand kind of filtered into shaping this for you and shaping that growth.
So going back to my roots as a banker and relationship management and all the key tools you use to just acquire and onboard. And again, it's cheaper to keep a good customer than to continue to try to source new ones. So use those principles. Our clients have been some of the catalyst of some of the growth we've done within the geography of Oklahoma, as well as our contacts here closer to home that are allowing us to grow. Yeah. So, and that's such a nice, safe place to be using these clients who trust you already, give them a little bit more rope and help them get to a new location, and helps you then learn a little bit more about a place that you never would have thought you would have done, or maybe an asset class that you may not have tried to lend on as a company. Those sorts of growth metrics really can enhance the speed of growth because you're trusting those who already trust you.
Makes sense. And I think kind of similar to your roots, like staying nimble and being able to react based on demand and when things change, customers are a key input to that equation, not just the market circumstances, for sure. Um, Ryan, you also at the beginning had this mental model from the family business, something that you'd seen work. So when Keystone went live, how closely did you stick to that script? Or I guess where did live customers push you off script or into different directions than what you might have thought?
Yeah, so Dan, we definitely did some things similar, but we also had the benefit of knowing what didn't work. And I'll give a couple examples of that as well. So one thing we initially focused on at Graysbrook was smaller loans, right? Kind of like the 1 to 200K loans, even in rural areas, lower loan to values. But what we found was that there was a higher risk of loss and default. The legal fees on a enforcement, foreclosure, power of sale are going to be what they are regardless of the size of the loan. So if you don't have that equity buffer there, so that was one kind of key takeaway we had, that we didn't want to focus as much, at least strategically, as a key portion of our portfolio on those smaller loans. Um, Another thing really that stood out was marketing. We used to focus on kind of just blanket marketing to 90 plus 95% of our leads come from mortgage broker partners here in Canada. And we used to kind of focus on marketing to all of them all at once, rather than kind of targeting those top performers that we knew were going to drive volume for us. And I'd also say on top of that, having targeted, consistent marketing has been incredibly helpful for us at Keystone. We run a weekly podcast with myself and my business partner that covers topics related to private lending and the mortgage broker space in Canada. We also have consistently, since day one, run a monthly newsletter and blog versus in the past, it was much more sporadic, right? So, we put it out there, but it was kind of like when time permitted. Now we've made a focus like this is a core to our business. There's a process in place. This goes out on the first or the second of every month. Um, I'd say early on, one big challenge that we had was with Keystone when we launched. We made a big push early to say, we're here, we're ready to play. But we didn't have those solid capital resources behind us as a new business. And despite the strength of those relationships that we developed for several years, I feel like the seed of doubt was planted a little bit with some of our broker partners, whether it was that we couldn't fund their loans or we didn't differentiate enough from the existing options. And looking back now, we never missed a funding, which we're super thankful for, including a couple times where we had to claw funds off of our personal lines of credit to make a deal work. But looking back, we likely would have benefited from a softer launch initially, say for the first 6 months, get our capital resources in place, and then kind of go big from there.
Yeah, makes sense. Well, you made it work. I think in some cases by the seat of your pants, it sounds like on a couple of these, but awesome. Great to hear. So we've talked a little bit about this, but let's kind of move into the systems and the structure side of things. Like, okay, we've decided we're doing this, we've got something that works, we've got the signs. So where does technology and systems come into this? Jake, kind of start with you. Curious about if Mortgage Automator was a growth enabler for you. Did you manage things manually first and then kind of hit a wall and bring in tech? And then, of course, outside of Mortgage Automator, other kind of key systems or biggest kind of systemic changes that you realized you needed to invest in to fuel this machine as it grew.
Sure. So we did make the choice early on to use technology as a growth enabler. We didn't want to get to that point where we were using Google Sheets or some other very manual system and all of a sudden lose track of a loan and lose money. That doesn't make any sense as an operator to do that. And so yeah, I think after about 6 months of being in operation in early 21, I picked up the phone and I talked to mortgage operator or automator, as well as a couple other smaller kind of startup mortgage systems, just to kind of get a feel for what was out there. Coming from the banking system, of course, everything is sort of there. There's the green screen and there's all the overlays to that, and it kind of exists. And so that was the feeling I wanted. Was just it was something very very tangible. It had very easy use, and it was allowing us to then scale without having to hire. Because I can only imagine the amount of human beings I would have had to have brought on early on to get some of the scale that we ended up hitting as we hit into 21 and 22, those growth metrics. And so I'm very happy with the choice we made to reach out and call Mortgage Automator and get onboarded when we did, because it really was an enabler for us not to have to like pull back and be like, man, we just can't handle more right now. When there was just a lot more the market needed out of us. And kind of to the point of Ryan, like we kind of wanted to continue to grow steadily and kind of continue to backfill that growth with the processes as talked about. And again, stay nimble as these clients who trust us ask us new questions and want new things. Can we get there? Do we have the systems and do we have the way to track it appropriately to make sure that we're not going to get ourselves in between a rock and a hard place? And so, that first iteration within technology has been a big part of us now moving forward and adding additional technology, construction loan management software, We're starting to use a little bit of AI as it comes to just doing our own reporting internally. But again, anything we can do to use technology to automate any part of some of these processes when we're running the scale we're running is has been a huge part of me not losing all of my hair quite yet, just most of it, and most of it turning gray. So
Yeah, that makes one of us. But no, super helpful to hear. So kind of you had that banking background to show that systems were required. I suppose the alternative would have been scaling up your team massively, which then causes risk of if you bring in systems later, then you have to kind of go backwards potentially with people. So you're able to avoid that negative as well.
yeah, and within private lending, one of the things I have seen that is, early on, it can feel very lumpy. This the traction you get, the client calls. You have a core group of clients, but they're all in a handful of the projects. They're not going to call you. So what are you going to do, and how do you market yourself again? So to not have to have manpower necessarily to cover that overhead early on, just use the systems helped us to continue to grow and have capital reinvest into loans, which now to the point where now we're growing the team, and now we have doubled the size of our team in the last 6 months, to now keep up with now a more consistent growth. But again, we already have all of the mortgage automator and the construction loan management stuff all set up and working well, and it's just about now putting people in the right place, for their own benefit.
Absolutely. Ryan, kind of same question for you. I suppose kind of on both levels, your original family business and then your own. Where did systems play a part in this? How manual did it get with like spreadsheets and things like that? Like, were there any kind of core triggers of, oh boy, we gotta bring in something to help scale this?
Yeah, a lot of Jake's experience really resonates with me. Thinking back, I still laugh to when I joined the family business and they were tracking loans with a 40,000 line Excel spreadsheet, each borrower providing 12 post-dated checks and payments happening randomly throughout the month. And I thought to myself, there's got to be a better way here, right? So we tried a different software for a couple of years. It was our first foray into software in the private business. We used the mortgage office temporarily. It was a little bit clunky for us, non-web based reporting, and the data aspect was frankly just not sufficient for what we wanted. So we ended up being an early adopter of Mortgage Automator actually, and we were really impressed with the demo we got from the initial founders at Automator, and particularly the customization potential because a lot of private lenders, especially in Ontario and Western Canada, aren't necessarily focused on the renovation, fix and flip, construction type loans. And Automator software even initially allowed us to customize templates so that we could have a construction commitment or standard purchase commitment or DSCR commitment. So that was super beneficial to us. Um, and again, just the dashboard being able to quickly understand the health of your portfolio, what your loan to values are, what your weighted average interest rates are. And for especially from a reporting perspective, this was a key thing for us, reporting to investors, reporting to regulators, having that data at the tip of your fingertips. And prior to coming into private lending, I worked in a data and analytics background. So this stuff was very important to me. So this was a big project that I had taken on, but it made it as an easy decision for us. When we started Keystone, we ended up starting with Automator from day one. So we'd actually signed off and had everything set up before we went live because we knew we were in this business for the long term. We knew we wanted to scale. So we said, why bother waiting till we're 10 or 25 loans in? Let's just do it from day one. So we've got everything in place. And that's been a great decision. And I've always said to our team too that having this software in place has saved us on at least one or likely two administrative headcounts. So you're talking, over $100,000 a year in salary, and having that software that you can depend on and keep things in track. Um, Other things I've focused on in the past too, especially coming into the new business, keeping your website, modernized, of course, keeping detailed contact information from any of your referral sources. We talked about process documents, but keeping your process documents evergreen, so checking on those quarterly or monthly or depending on what the best fit is for you. And I touched on it before, but consistent marketing material as well.
Yeah, it makes a lot of sense. I'm just kind of curious too. It sounds like for both of your businesses, you had the benefit of kind of launching systems early on. Ryan, when you think of the family business that had to go through that conversion, like that's probably a ton of work at the time. For people that are on this webinar thinking, ooh, like that is a lift to get to this point. Like any thoughts on we're already there, or if putting that decision off actually becomes more helpful? Like you went through that process of converting, right?
I won't sugarcoat it. It was challenging to get set up initially when we were, already had 100 plus loans on the books and we're having to move those to a new software. The automator support team was actually super helpful with that. So we were able to export a lot of our data and move that right in, and that populated a lot of the loan base there. We still had to make some manual changes after that, but it was one of those things that, like, yeah, it was painful for a month or two as you go through it, but then you're so thankful once you have it in place and you have those tools at your fingertips, things are running smoothly. So it's, short-term pain for long-term gain, of course.
Yeah, yeah. I mean, I think of this within our company, we have our own systems. Making any change is pretty painful at the time because you're both used to whatever you were doing before. Even if your 40,000 line Excel spreadsheet was crazy, you knew how to use it. But I think that long-term benefit is something you don't feel until it's there, right? So it makes sense.
Yep.
Jake, just kind of on that growth, staying on growth and systems and structures, I think like capital is a big side of this. Like investor relations, capital. How did you think about fueling growth for investors? Kind of what worked, what was harder than expected as that grew? I think I can.
Thanks. It's hard to talk through mute, gotta be honest. So kind of the story of Defiance Capital, the initial idea was more of a debt strategy with some family and friends just to help kind of raise some money, very much internally, um, sell them kind of on this story of what we're doing within the Oklahoma market. And then, we kind of hit a milestone in terms of just overall loan outstandings. And we said, cool. Um, we need to be smarter about this now. We've got a substantiated business that we can now market out there. Let's get a fund. So we do have a full fund that we have now been operating for about 18 months, raising capital to help us now start to look at bigger deals, different deals, asset classes, just as a scale component to meet our clients where they are. Because again, the funny thing is you help a client with some small singles and doubles, all of a sudden they have networks, and all of a sudden they ask you for the home runs, and those home runs take a little more time, a little more effort. So we've been focusing on that growth within that. Within the fund and within our own philosophy, going back to mutual success, the fund was just built around being a fund that was friendly for investors to be a part of. They would feel the true interest we had in them as we were growing the business. Being able to show them a proof of concept, showing them that we had true systems and technology in place, right? Like, hey, investor, here's a 40,000 line Google Sheets. Going to be hard for them to be real confident that you actually have all the processes in place and to be able to just click print. Hey, here's our loan tape. Here's where the loans are. And be able to like even say like here's where some of the stress is within the portfolio, and that's just the honest truth, right? You make enough loans, eventually some of them start to cause you gray hair. um, Now the growth has been a little bit slower than we thought. I think specifically because we are so geographically focused, some investors are kind of turned off by being so tied up in that, and that's why we've been working to expand into more parts of Oklahoma, Western Colorado, and showing folks that we have the ability from a dynamic and from a process that we can do bigger things, and we can take the capital and truly make a good return with it for the investor on a safe and sound basis. And so, like I said, now that we've got kind of over that first year, some of the investors who were kind of on the sideline have kind of weaned their concerns, and we're starting to get a few more phone calls as the newsletter keeps showing up that we're continuing to hit kind of our trigger and goal with the fund.
Yeah, it makes a ton of sense. And I think that consistency is just confidence building overall. So it's that snowball effect over time for sure. Okay, well, we're getting closer to the end of our session. I want to make sure we have time for questions, but before we do, the last kind of broader topic will just be blockers and some key takeaways. But Ryan, can we talk about some things that you tried that didn't go as planned? You know, everyone runs into these things, look great on the surface, and then you dig into it and realize it's not what you expected. So, anything that you didn't see coming or obstacles that were unexpected?
Yeah, a couple things come to mind there, Dan. I touched on some of the speed bumps we had in Keystone's first years with some of the doubt from broker partners. We'd expected 100% support, just due to the strength of our past partnerships and these relationships, but it didn't necessarily play out that way. And that took time to develop that track record with a new brand, despite those past relationships. Another one that really stands out for me is when after Graysbrook was acquired by this credit union, they really, of course, wanted to grow the business. So we were based in little old Atlanta, Canada, with a smaller population based. They wanted to eventually expand it nationally. And we started that with Ontario. And I led this expansion, and my primary focus was, attending the larger conferences in Ontario, focusing on a smaller number of broker partners that I knew in the market as well. But unfortunately, it just didn't drive the volume that we had expected. And a couple of things I attributed that to, I'd say one, lack of consistent presence in the market. We had no boots on the ground formally there. We didn't hire someone permanently there. That certainly would have been a key catalyst for likely driving more. Um, Overall, despite the fact that myself and some of my coworkers had lived in Ontario before, we still had relatively limited market knowledge. And of course, the people who are on the call and yourself, Dan, Ontario is a highly competitive market, very established private lending brand. So it's like, why are you guys any different, right? And we charge higher rates out here than a lot of Ontario too. So it's like, why would we pivot and go to you guys? So we ended up shifting our strategy a little bit and focused on more kind of tertiary markets in Ontario outside of the GTA, and that helped a little bit. But it was definitely a learning experience, and it didn't go exactly the way that we had expected.
Yeah, fair enough. And for anyone on the call not familiar with the market, I think Jake, you kind of touched on something similar, but like Ontario is a huge population base in Canada. It's a massive market for potential for lending, just because most people in Canada live in Ontario and around the Greater Toronto area. So Atlantic Canada would be a smaller market as a whole, but again, probably less operators that are targeting that market too. So the desire, I think, to go into the bigger markets is always there because the potential on paper is huge. But then, yeah, sounds like as you start to tackle it, realizing that there are things, whether that be people, experiences that make it more difficult. I think we've probably all been there at some point. Uh, Jake, same thing for you. Any kind of like swing and a miss or any kind of strategies that look great on paper, and then when you got into it, realized you had to pivot a little bit. And what did you learn from those?
Yeah, so I think for us as we were growing, we are located in a kind of rural mountain area, and honestly, staffing has been a big problem for us because we're not in a big metropolis with a lot of access to some of the employment bases that probably would be beneficial, and some of that's even then at a cost to bring on the right people. So we did venture out, and we've done some work exploring some remote options, and that is I think it depends on the process you have in place to make those work the best you can. But additionally, when you get into being hyper focused and people start to notice you because your kind of your name's popping up in a lot of conversations, is you do end up having a lot of kind of copycat sort of companies start to pop up, like, oh, if Defiance Capital can do it, I can do it. And so, being true to your processes and your strategy has helped us weather some of that competition that has come in because people again saw success, and so they figured anybody can do it. But I think Ryan can attest. Um, lending as a whole, as a art and a science is a lot to take hold of and do right and effectively for yourself, your shareholders, and the client that you're working with. So
Oh, I was double muted myself. Thanks so much for sharing, Jake. I'm sure it's nice to hear. People are probably like, is this just me? No, these are these are challenges everywhere for sure. To close it out, then, Jake, any kind of key takeaway that you'd share with the audience, if people are trying to scale, like what is the most important thing that they should be thinking about, or your biggest piece of advice for someone running into this?
sure. So, I mean, first off, you've got to have that strategy. Ryan and his team he spent all that time, all those pages of paper spent to kind of come up with how they're going to do it, and implementing the processes, right? Because once you start to zoom past 300, 400 loans, if your processes are broken, you're going to start to see that trickle down, and your shareholders are going to be affected, and your clients are going to be affected. Um, and sometimes those processes are going to be a little reactionary. You get a little bit of a curveball that you don't expect, even though, been resting a little bit on my laurels as a lender over time because there is something about being in lending for 15 plus years that there's just a lot of pent up knowledge in my brain that I'm still trying to get on pieces of paper, as one can imagine. But getting those processes out there, being able to be intentional then with your growth, and again, be true to that growth. Don't just react and just do something. Being nimble and being dumb are two totally different conversations. And I like to stay nimble, reacting to the clients who trust us, and finding ways to then grow them, which helps us grow ourselves.
Love it. Excellent. Um, Ryan, can we switch over kind of your biggest kind of takeaway, anything that you would share for people in the same boat?
Yeah, absolutely. And great points from Jake there. I think the big thing is you want to be ready. Like, and do you really want to scale at the end of the day, right? Do you really need to do this? So maybe you've built up that capital source and you've got the fund or you've got the big line of credit, but how do you maintain those profit margins, right? So, growing your book is great, growing AUM is great. But if you're making the same bottom line that you were when you're, a $300 million portfolio versus a $50 million portfolio, and you're adding all this staff and complexity, like, is this really the strategy that you want? And maybe it is, but it's something you really need to consider, right? Because sometimes, and I've been guilty of this too. Egos come into play in the business too, right? You hit 50 million one year, you want to get to 100 the next year. But there's a lot of businesses, and I know we're talking about scaling to 300 loans. If you're making money at 50 loans or 100 loans, and you don't want that added complexity, maybe it's in your best interest to stay in that wheelhouse, right? So, but what I would say, and just kind of reinforce some points I've made already: invest in your processes, invest in marketing, pick the right partners. Jake mentioned it, picking the right people and having in the right seats and just staying consistent over time and good things will happen in this business.
Yeah, love it. Excellent. Well, thank you both so much for the conversation. That was kind of the core questions that we wanted to get through. We have had a number pop up as we've been speaking. So, Jake, Ryan, thanks for sharing your story. Super helpful. I think that I'll go through these questions and feel free to jump in as you both like. We've got about 4 or 5 of them, so about 15 minutes left. Should be able to cover all of them. Um, but one of the first ones was, how did you score the deal flow to support growth from 30 to 300? Did you hit a broker relationship management cap? Like, how did you think of this?
Yeah, I think from our perspective, it comes down to product suite at the end of the day, right? What you're offering. If there's an opportunity there to expand on that, whether it's commercial loans, construction loans, DSCR loans, really depends on your strategy, but expanding at least from our perspective, expanding the product suite has been the first lever that we've pulled versus looking geographically for expansion. And we've discussed both options too. Some other areas I've seen other successful private lenders do, especially bigger ones, is they expand more into like the B space as well, where they've got that more secure client profile and the more stringent credit checks on them, and maybe it's a lower margin, but they really want to chase that volume, and that's another opportunity there for expanding total book size.
Great. Thanks, Ryan. Jake, anything to add there?
Yeah, and for us, I think the overall infrastructure is slightly different here in the US than in Canada. I don't have a huge broker network. I actually have zero brokers that send me deals. My advocates are my proof of concept with clients who see that we believe in them and we give them the access to the capital they need. But on the professional side, for us, it's the attorneys and the title companies who see us show up at the title closing table with the funds as presented, as expected. No funny business. And they see that their clients love to work with us when they sign the loan documents, and they're doing their fifth or sixth loan in the last 9 months. And they're like, "How did you do that?" Right? It's having the right partner. And so those sorts of stories then um, dive into how we've continued to grow our loan scale over time.
Awesome. This one's pretty specific. And it probably ties to like if you get your systems and focus done before you start growing or the other way around. But it was really when you're scaling, what roles did you hire for first? Underwriting, admin, sales, like what's the most important place to start as you start growing?
So for us, because we had Automator in place, it was having the right then additional underwriter to support the growth to make sure that then we were continuing to make fast decisions that our clients expected out of us. From there, we did then add a admin position, operational position that then, as we were scaling, was making sure we were using Automator to its maximum potential, using the portal access that it gives us to give our clients so that we were getting the appropriate documentation on time in a safe and secure way. And that's one of the huge things MA has allowed us to do, is giving us all these additional tools within what Mortgage Automator has to look professional, to stay secure, and again, to send out a portal link and all your clients have to do is upload stuff is fantastic for that growth and that efficiency of growth, because you're not having to chase emails all the time.
Excellent. Ryan, how about you?
So I'll go through it from both experiences I've had. So initially, there was two co-founders in the business. First hire was an underwriter as they started to ramp up a little bit. Then they hired, I think, a finance manager and then an admin, and I was the last hire as a business development manager there. And when I started Keystone, I had two co-founders. One, like I said, was underwriting background, so he managed all of the underwriting and risk management side of the business, and the other one was capital raise. Obviously, I had involvement on both sides, and since we've added an executive assistant and a junior underwriter as well, and we'll likely continue bulking up on the underwriting side as volumes have been pretty strong. And I think business development will be more so down the road. But from my experience, having capacity on the underwriting side is critical to maintaining that efficiency and building in that trust with your referral partners.
Great. Okay. Thanks so much, Ryan. Appreciate both perspectives. It's a good A/B test. Since you were talking, I guess we can maybe get your perspective on this next one and then flip over to Jake. But it was as you were growing, like going from 30 to 300 or just experiencing that growth, did you have to lower fees to get more business and get more market share? Like I would imagine there's an element of this that comes with scaling, but were you able to keep profitability the same or in the same ballpark? What did that look like for each of your businesses?
Yeah, that's a great question. So I would say, we weren't able to hold pricing exactly the same, but it was very similar. I'd say, initially, maybe with the initial business, average loan size went from, call it 300K to six, 700K on average. And we probably dropped, around a 1% in fees, maybe 1 or 2% on rate. So, and that was on those larger deals, right? At the end of the day, not all deals we would have to discount on pricing, but naturally, when you're talking $1 million deals, you're going to get more pushback on a 2 or 3% fee versus a 100K loan. So yes, we did have to give up a bit. With our current business, we've been very firm on our pricing. We've held our pricing really strong, especially where we're still ramping up right now and the demand is still there. There's been just no reason to discount. And right, like we do lose out on some loans to competition, but we're still making strong margins, right? And we're just shy of 100 loans right now. We're doing fine where we are. Yes, we want to grow. Yes, we want to get there, but we're going to do it strategically and not just give away on pricing right away just to achieve that scale.
And as the brand grows its reputation too, that allows you to sustain versus kind of loss leader tactics for sure.
Exactly.
Great. Jake, how about you?
So I will kind of mirror Ryan a little bit in terms of with our current demand and our current growth trajectory, um, we're not really doing a lot of budging with our pricing. But what we are doing to make sure we combat competition is as our clients grow with us and gain confidence in us and them, trying to be a little more dynamic with how we price for them and not just be stuck in the mud with just a certain price and certain fee. So if you've been able to do a certain amount of projects with us, if you're and then digging down into geography and where the house is and its liquidity as a property, taking those sorts of metrics and allowing that to then be more of a competitive price to combat potentially somebody trying to be the loss leader to come in and take a good client away from you. So again, it's that discipline to your process, but understanding that other people out there see what you're doing and they want it, to just be smart and to help your profitability kind of keep a consistent pattern for yourself and for your shareholders. So
Excellent. Okay, well, this is the last one. It is an MA specific one. I think we've got people on the call that use origination softwares, but it was more detailed, like how you use MA or how you would use a system to originate, 10, 15 plus loans per month. I will just say, like, if anyone actually wants to see MA, you've got the QR code on the screen. Feel free to reach out to us and we can show you what it looks like. But I think it's more of a question of like, if it's manual right now, like how does this actually work? How does it help with scaling? Ryan, well,
let's see. I
Jake,
think
yeah.
there we go. I got the unmute cue, so I guess I'll talk first. So
Sure.
Um, well, I guess because we adapted early on, I remember the Google Sheets day of just like I think we were color coding stuff to make sure it was closed or is in process or some well, all of a sudden, Mortgage Automator within the dashboard and the way we have it organized, be able to move your loan from subsection to subsection. It's clear, it's right in your face. You see it every morning, and you're actually actively able to then move deals along so that you can really follow yourself up. It even tracks how many days something has been in a substatus. So if you've got a loan that's been sitting in a substatus for 10 days, why is it sitting in the same substatus? What are we missing? What do we need to do? And so, again, keeping those sorts of metrics top of mind with how you want to manage your sales flow, though that is how we've managed our deal flow and using Mortgage Automator to be the advocate to help us stay organized, keep the deals from getting stuck in a Google Sheet and forgetting that we even talked to that client and move it along. My underwriter will underwrite a deal, immediately put it in a Mortgage Automator into under review. So every deal that comes in, the input is just in MA. And if we end up killing it, we kill it, but at least we know it existed and we don't lose track of anything.
Great. Ryan, anything to add there?
Yeah, I think Jake nailed it there. The in progress loan feature is incredible. I love it, especially as an operator of the business, and I get to keep pressure on the underwriting team to see where these loans are at because they get busy and stuff gets missed. But I can see that flow every day. It's the first thing I open up in the morning. and keep the tab open all day. A couple other things I'll mention as well that have been super helpful is the security of the submission platforms that Automator is tied to as well from broker submissions. I mean, it's just incredible how that comes in. There's no manual work required other than changing your rate and fee at the end of the day. Your documents are all pre-populated already. And of course, you get the security of a secured credit report coming in as well through the system. Um, Documentation in general on the Automator platform, just where you can keep all your docs within that file there to keep things organized. And another thing Jake mentioned earlier that I wanted to comment on is just the trust that's gained from your investors as well and your shareholders. Being able to show them the legitimacy of this platform and how you're tracking your data and how you're on top of your numbers has been, it's hard to measure how impactful that's been for our business.
Awesome. Well, we're happy to be a part of it for both of you. I think the whole goal of these systems is to allow lenders to focus on growing their business, not on the administration side of it, and kind of feed that data to allow you to do that. So very cool. And as I said, anyone on the line who wants to chat with someone at MA, see it for yourself, please follow the link. Let us know. Jake, Ryan, thank you so much for sharing your story. It's really helpful, I'm sure, to anyone that is thinking of, do I take that next step or not? Ryan, I kind of love that point that you raised of like, make sure you want to do it because it does come with things that, you might be pretty comfortable where you're at and maybe you're not ready for it. And then Jake, I love the kind of maniacal focus on specific markets and shutting out some of the other things that might be the bigger opportunities, but staying true to kind of your ethos, your DNA of the business. It sounds like it's really allowed you to keep growing and remain true to the business you want to build versus be influenced by other factors. So yeah, thank you both so much for the call, for sharing the story, and look forward to chatting again soon. Thanks everyone who joined, and we'll be sending out a recording of this to everyone that signed up as well.
Thank you, Dan. Appreciate it.
Thanks, Dan. Thanks, everybody.
Thanks everyone. Have a great day.